Hi everyone, welcome to this presentation from Morningstar. My name's Nick Moles. I'm the Head of Marketing at Wren Sterling, and today I've been joined by Keith Speck of Morningstar. Just a little bit about why we're doing this. So Wren Sterling's been working with Morningstar for a little while now. They're on one of our panels of investment options, and Morningstar is a global business. So I'll hand over to Keith and let him introduce himself, and then we'll get straight into the presentation.
That's great. Thank you, Nick. And it's great to be here speaking with you in these turbulent times about the importance of staying the course and the benefits of diversification. My name, as you say, Keith Speck. I'm a portfolio specialist at Morningstar Investment Management Europe. So sit closely with the investment team and liaise with our sales teams in getting our client message out there. If we start off thinking about the noise that we hear in markets, and there's a reason that we tend to only hear about looming market doom or imminent market growth. Essentially, news outlets, be it the radio, the television, or the printed press, need to draw people's attention with wildly bullish or bearish predictions. And these sensationalized views can be a distraction to an investment approach. So when investors are tempted to make a radical change to portfolios based on these headlines, it's important to recall some basic fundamentals to keep your plan on track. So firstly is to drown out the noise. Market movements are notoriously difficult to predict. Media outlets that scream the loudest are not always the most accurate. The fallout from attempting to time the market in response to one of these predictions can be dangerous to your portfolios. Secondly, look but don't stare. Whilst it's important for investors to know the performance of their portfolios, short-term market fluctuations can be volatile. While the probability of realizing a loss within any given day is high, the likelihood of realizing a loss historically has decreased over longer holding periods. Periodic reviews of investment portfolios are necessary, but investors shouldn't let short-term swings affect their view of the future. And finally, stay focused on the long term. Investors who've taken the time to determine an investment plan based on specific goals and risk tolerances are best advised to stick to that plan. Whilst it may not always grab headlines, a sensible, tailored investment plan may be the best solution to help meeting long-term goals. I'll take us through a few slides that support what we think are some investment truisms during these volatile markets. So firstly, we look at the importance of staying invested. And one thing that we hear a lot about when markets fall is it best to pull out your money and wait for stability to return to markets? You may have heard this, you may have thought it yourselves, but it's simply not supported by the evidence. We can see in this graph that if you pulled out of shares during the last market downturn, you'd have had a harder time meeting your financial goals than if you'd stayed put. On this chart, we're looking at how £100 invested in the year 2000 would now be worth £319 to the investor who stayed the course. And that's even after the 2008-2009 downturn and some the more recent turbulence we're seeing. If you pulled out at the bottom of the last downturn, held on for a year before getting back into shares, you'd have a third less than if you'd stayed the course. And of course, those that never got back into stocks ended up not participating in the longest bull market in history. Now, not all recoveries will yield the same results, but investors are well advised to stick with the long-term approach to investing. On this slide, we're looking at market recoveries in the US after several financial crises for a balanced portfolio, and that balanced portfolio being 40% bonds and 60% stocks. The image shows the cumulative returns for that portfolio after 6 historical US financial crises. Now, in the short term, uncertainty from such external shocks can create sudden drops in value. For example, the balanced portfolio posted a negative return in the month following 3 of the 6 analyzed crises. However, over longer periods of time, returns were much more attractive, and investors who stayed the course reaped considerable rewards. Now, fear and uncertainty could lead investors to sell their investments during tough times, and that's putting downward pressure on prices. Trading because of these emotions can be detrimental to a portfolio's value. By selling during downward price pressures, investors might realize short-term losses, which may otherwise just be short-term paper losses, but by selling, you're actually crystallizing that loss. And that's compounded as investors wait and hesitate to get back into the market. People just fear uncertainty, and this hesitation can result in them possibly missing some or all of the potential recovery. I think the lesson here is that patience can pay dividends. Diversification can also limit losses during turbulent market conditions. One of the main advantages of diversification is reducing risk over the long run, not necessarily increasing returns. Now, while stocks offer the potential for higher returns, the downside risk can also be extreme, as we've witnessed in the recent market sell-off. So a diversified portfolio can help mitigate such extreme swings in value. Market timing, we all hear about market timing. It's one of the most difficult things to get right on a consistent basis. And I think investors who attempt to time the market run the risk of missing periods of exceptional returns, and that leads to adverse effects on the ending value of portfolios. If we look at the bar chart at the top of this slide, this illustrates the risk of trying to time the market over the past 20 years by showing the returns investors would have achieved if they'd missed some of the best days in the market. The bottom chart that looks extremely busy illustrates daily returns from the 5,035 trading days we've had over this period. Now, investors who stayed in the market for all of the days achieved a compounded annual return of just over 6%. However, the same investment would have returned just around 2.5% if it had only missed the 10 best days for stock market returns. And if we go all the way over to the right-hand side and looking at missing the best 50 days, we're looking at a loss of 5.5%. So even though the market exhibits tremendous volatility on a day-to-day basis, over the long term, investors who stayed the course were rewarded accordingly. Now, the appeal of market timing is obvious, improving portfolio returns by avoiding periods of poor performance. However, as I said, to get market timing correct consistently is extremely difficult. An unsuccessful market timing, which is, to be frank, the more likely result, can result in a significant opportunity loss. Now, my final point on staying the course is illustrated by this slide, and it really shows the importance of thinking long term. If we look at the bottom of this chart and then work our way up, we can see that there's never been a 15-year period in the US stock market, and we're using the US as a proxy for global developed markets, that hasn't delivered a positive return. As we move up the chart and shorten the investment horizon, the probability of a loss rises, but even at just a 1-year horizon, the chance of a loss is just 1 in 4. Now, I'd look at that in 2 ways. Firstly, even if you can look out over a full year rather than just looking at the last weeks or months, there's been a decent chance historically for a gain. And I think recently, if we look at results of the losses in the US equity market in March, depending on the index, you're looking at around about 13%. But that's a lot less than some of the peak to trough losses that were seen during that month. So we can lose sight of the fact that the second largest one-day gain in the history of the US market occurred in March, and during this big sell-off that we've been seeing. So yes, we've seen a lot of down days, but there were up days too. And over time, historically at least, the up days have outnumbered and outpaced the down days. The other thing to note about the 1 year figures is that every year on average, we'll expect a 1 in 4 chance of having a negative year. But when you look at the long run returns from shares, you can see pretty decent returns. And that's included losses in 1 out of every 4 years. So really the message here is that investors in stocks shouldn't be afraid of losing ground from time to time. In fact, we should expect it. It's part of the investment journey we go on, and we need to be patient through these times, and then trust really that historically, at least, those up days have always returned. So if we look at the benefits of diversification, and I guess if you've ever heard the expression, don't put all your eggs in one basket, you've got a good sense of what diversification is. To practice this in the context of investing means diversification, or the strategy of holding more than one type of investment, such as shares, bonds, or cash in a portfolio, helps to reduce the risk. But more than that, you need to be investing in assets that behave differently to the same factors. So an investor can diversify amongst their stock holdings by buying combinations of large, small cap, overseas stocks, as well as your local market. And within fixed income, buying short and long dated bonds, buying government bonds, or indeed investment grade or high yielding bonds. All of these assets can help with diversifying risk within portfolios. And they help reduce risk because the assets do not generally react the same way in changing economic or market conditions. And I think that's especially true for assets whose underlying fundamentals or the source of their cash flows differ from other assets in the portfolio. Now, diversification doesn't eliminate the risk of experiencing investment losses. However, by investing in a mix of different investments, investors may be able to insulate their portfolios from any major downswings in one investment. Looking at this no risk, no reward, and if we look at long-term capital market returns, that gives some insight into the characteristics of various asset classes. What we're looking at on this chart, the light blue line, we can see emerging market equities have produced greater returns and a higher ending wealth value than developed market stocks, the darker blue line, and indeed than global government bonds, the yellow line. However, we can look at the shape of the graph lines, and you can see that the higher returns from emerging market stocks are associated with much greater risk and much greater variability within the performance. Looking at global winners and losers, and again talking towards the benefits of diversification, it can be useful to look at historical performance by country or region and category, local, international, and emerging market stocks and bonds. And looking at this chart, it becomes apparent that it's impossible to predict which asset classes will be the best in any one given year. And this image can suggest that by taking advantage of opportunities abroad, you may experience higher returns than if you stay solely in the local market. It's nearly impossible to predict which market will be the top performer in a given year, but it can be beneficial to hold a portfolio diversified across several countries or regions and differing asset classes, equities, bonds. And the independent movement of global markets can provide considerable diversification benefits when held in combination with local investments. So investing a portion of a portfolio in different assets, in different asset classes, in different countries, you can benefit from reducing volatility or risk within portfolios. So just looking at a chart showing a variety of hypothetical portfolios with different equity and bond allocations ranging from 20% equities and 80% bonds at the most cautious end, that's the green line at the bottom, to a portfolio of 95% equities and just 5% in bonds. That's the orange line at the top, and that's at the more aggressive end of the spectrum. Clearly what this shows is that if you want to deliver higher returns, this can't be done without taking risk. We can see that risk and reward are connected in the long run, even when taking into account the market declines that we saw between 2007 and 2009, and again in the first quarter of 2020. Broadening your time horizon is important, but even more so is investing in a manner that is consistent with your personal attitude to risk. I hope that this has been helpful to you and your advisors, your investors during these stressful times. And once again, I really appreciate the opportunity to speak with you today. And more importantly than anything at these times, really is to stay healthy.
That's brilliant. Thanks very much, Keith. I think that presentation really has, I guess, reinforced a lot of the messages that people will be reading in the media and particularly from their advisor over the last few months as well. So thanks a lot for your time today. It's much appreciated.
You're very welcome.
All right. Bye, Keith.
All the best.